Hey everyone, welcome to Mississauga Life and Real Estate Podcast. Today we are getting into the recent rate hike announcement, trigger rates, and the latest market update. I'm your host, Shan I, and co-host Alex Stakic. Alex, how are you doing today?
I'm very good. Thank you very much, Sean. I'm looking forward to discuss about these really amazing topics, and I'm pretty sure people will look forward to hear more details, right?
Some very, very important and relevant topics for today. Before we get to that, are you prepared for the amazing weather we're going to be having? 2 feet of snow over the weekend.
I know.
Are you ready?
I hope so. Let's see. We'll be in touch on Monday to see what is the development story.
Yes. According to the city, lights will go out, windstorm could happen. Everything's going to be a big skating rink. So be careful out there. Whoever is listening to this, I hope you get to this, get through the storm with safety and ease. Okay.
Absolutely.
So let's start with the recent rate hike announcement. So Bank of Canada raised the rates again December 7th. It was the 7th rate hike for this year by 0.5. Based on the notes that I read, Alex, it felt to me that they haven't shut the door on the rate hikes. I think there's going to be another announcement like you and I talked about in January. So there potentially might be more interest rate hikes.
Yes, most probably. Yes, you're right. And there's some gossipings that actually not only gossipings, you can go to Bank of Canada website. You can see it's mentioned that they will consider potentially another rate hike increase on 25th of January, but nobody knows it will be 0.25% or 0.5%. We'll see.
Yeah. So, I just want to get into a little bit of what it means practically for people who are listening. What does a 0.5 interest rate increase mean? And I had this example, if you were talking about a mortgage owner with a variable rate, you're looking at for a 0.5 increase, you're looking at about $176 per month for a house that's about $700,000, or your mortgage of $700,000 rather. And if you're looking at a home equity line of credit, then you're looking at for every $100,000, your payment's going to be up about $537, about $45 for every $100,000 that you're borrowed. The 0.5 increase is going to add another $40 to your monthly payment. So you do the math, $100,000, $40 a month, double it, triple it, and that's how much you're going to be paying. And that's what 0.5% increase means in practical terms for people out there who are mortgage holders or have a home equity line of credit. So one thing, Alex, that we have been hearing a lot about is because of the interest rate hikes, there is going to be some people who are going to be in the territory of trigger rates, trigger points. This has been going around in the news and the media a lot recently. I guess it's always been kind of relevant when the interest rates started going up, but the more they go up, the more people are affected by it. And I think that's why it's a relevant topic to kind of get into a little bit.
Absolutely. I agree with you. And, everybody's asking ourselves, actually, we all also ask ourselves, what is the best course of action with these hikes, right? Rent hikes. Should I, if I'm in a variable rate, should I lock? If I'm locking my rate, for how long I should lock my
$1 million question.
Yes. So generally speaking, people have to be aware of some very simple facts. When you have fixed mortgage rate, if you have to sell property, you are not buying property, and actually you're breaking contract with the bank, you can suffer severe penalties because you're breaking fixed rate, right?
Right.
Whatever it is.
Yeah. Find out what the penalties are before you get into the contract.
Yeah. If you don't have flexibility to move from fixed rate to variable rate, but on the other hand, you bought your peace of mind for designated period of time, and you know what is your interest, you know what is your principal payment for this couple of years, whatever is the term you took from the bank, and now most probably these people are not under stress of these high interest rates. On the other hand, if you have variable interest rate, your benefit is that usually your interest rate is lower than fixed rate, but you have flexibility that you can sell your property with only 3 months interest payments, right?
Right.
So in most cases, Canadians are using variable interest rates, right?
Okay.
And now question is, and I was also asking myself what to do now, maybe one temporary solution. I'm not mortgage broker to give some firm statements, but from my point of view, it's simple calculation. To buy temporary peace of mind, because we don't know how many mortgage hikes we will have in next year. We are only in a gas zone. Maybe it's good time right now to take fixed rate if you can for maybe 1 year, maximum 2 years, and at least to buy some piece of time, see what's going on with the markets. Maybe if the rates will go down, you will not get the full benefit of this decreasing of the mortgage rates, but at least you will not be affected with the potentially even higher increase of the rates on the current market. Nobody is, so clever to make decisions what to do, right?
And there is a disclaimer here that, absolutely do your due diligence, talk to the mortgage broker.
Yes.
We aren't in the mortgage business, but, we can give your opinions, but definitely do talk to a certified, licensed mortgage broker to get their opinion on what to do. And at the end of the day, ultimately, it's going to come down to what your comfort level is. If you're going to be okay with a fixed rate or a variable, because right now, fixed rates are lower than variable. Variable has actually gone up above fixed rate. Now, is it going to keep going up? Is it going to stay there? Nobody knows. That's something that you have to kind of talk to your family about and see what you're comfortable with, right?
I made some calculations on my own, for example, because most of us have payments on monthly basis, right? So I was calculating and you can go to, for example, TD online banking and use their mortgage calculator. And just really roughly, I used present highest fixed rate and what's going on with the terms of paying on monthly basis and weekly basis. So in my particular case, I would be paying weekly about 8% comparing what I'm paying right now on monthly basis, because you're shrinking the interest portion on weekly basis, and this is part of your saving mostly. Right. But again, as we disclosed already a couple of times, you should figure out what is the best course of action, discussing with your licensed mortgage broker in the bank, and make a right choice.
Okay. So now we have the reason why trigger rates and trigger points are becoming more and more as a topic being discussed more and more. You basically have three types of mortgages. You have fixed, which we talked about, which is fixed for a term, 3 to 5 years, 1 year it could be. And then you have variable. Even within variable, there's two different types. There's variable, like that's a fixed, and then the ones that's not fixed. Right, which is adjustable. So a mortgage rate which is adjustable pretty much means that you have the variable rate, and when the mortgage rate or the interest goes up, then your mortgage payment also goes up to keep up with the higher interest rates.
Yes.
And then at that point, you're aware, okay, my mortgage payment is going to be higher, so I need to have more money in the bank. The other one, which is a fixed payment, which I think most people have, is that your monthly payment doesn't change. If the interest rate goes up, more of your payment goes towards your interest rather than the principal, right?
Yes.
Now, the term trigger rate pretty much just means that once you've gotten to the point where the interest rate has gone up so much that even your entire payment is not covering the cost of your interest rate or your interest payments, then that's a trigger rate. And that is a point where a lot of people are at, and that's when you have to kind of sit there and kind of question about, what is going to be the strategy going forward? Because keep in mind, rates could go up again.
Yes, and even you can calculate on your own what is your trigger rate. Of course, you have to keep in mind that your final trigger rate may vary, and you should see in your mortgage statement what is your trigger rate. But it's very simple. First, you have to determine the amount you are expecting to be charged for your each mortgage payment. It doesn't matter if it's monthly or weekly or bi-weekly.
Right.
You have to confirm number of payments you're required to make in a year. Check to see how much of your mortgage balance you still have to pay off. And when you have all these details, calculation is very simple. Take your payment amount and multiply by number of payments per year. Divide that amount by the balance owing to the mortgage, multiply with 100, and that will give you a rough estimate of your trigger rate. And what does it mean? That means from that, you will get probably the notice from bank in the written form that you're actually hitting your triggering rate. And from that moment, you will have exact amount. What was your previous monthly payment or weekly payment, and what is onwards that payment. And as many increases of rates we will have probably more, as many notes from the bank in the written form, what is your new payment from next month.
Yeah. And trigger rates are not to be taken lightly, because what you'll find is your bank will let you know, like, hey, look, your payment principal is not being paid off at all. Everything's going to interest. And in some cases, even the interest portion is not being covered by your fixed variable payment. And then what ends up happening is that interest gets deferred onto your next payment, and the next payment, and the next payment. And then the interest accrues interest on top of the interest, and you could find yourself in a very messy situation, which is also known as negative amortization. So let me just tell you word for word. You've reached your trigger rate, you've stopped paying off your mortgage and started borrowing more. And that is called negative amortization. So, that is not a place you want to be in. You need to kind of take action right away. If at all possible, increase the size of your monthly mortgage payment. I know it's easier said than done. Otherwise, getting to the point where you reach your trigger point it gets very, very dangerous. And the trigger point basically is, Alex, maybe you can jump in with this, but it's pretty much like, let's just say, you have a mortgage of like $1 million. You've had it for a few years or a few months. You've paid off a little bit of the principal and the interest. You're at, your loan's at like 950 now. But now, because you kind of reached a trigger rate and all you're doing is paying interest, and not even that, your loan goes back up from 950 to over $1 million. So you ended up with more money than you had initially borrowed. And at that point, things can get very messy.
Absolutely. So you mentioned one of the solutions, because people will ask, okay, what are my options once the trigger rate is reached? Right. So you already mentioned one. It's increasing monthly payments, because by increasing the amount you pay towards your mortgage, you add so-called cushion room to your trigger rate, and you're still exposed to the ups and downs of the prime rate, but you benefit from putting down more towards your principal each month. And this is one of the options. Another option is convert from variable to fixed term, right?
Right.
Because in that case, you have peace of mind. I log that. I know how much is my payment. Nothing will be changed. Even if mortgage rates are increasing, I know my numbers, and I will follow what I have to pay. Otherwise, you're going to negative calculations, right?
And maybe look around and see what your portfolio is like. If you have investments, if you have stocks, just do some calculations, and maybe it might be the time to sell those and put those into the mortgage instead of keeping them in the stock market, just so you don't lose your home or anything like that, right?
Absolutely agree with you.
And the one thing that you can do, Alex, that a lot of people are doing actually, I think we mentioned this in the previous podcast, but TD has about 25% of their mortgage holders switch to 35-year amortization as opposed to 25-year. So it seems like a lot of people are doing that. That might also be a way of going. Keep in mind, when you go 35-year amortization, obviously you're going to be paying more interest overall. But this is something that you want to be doing temporarily. When the rates come down, then you can obviously change your terms and get a short amortization at that point. But so these are some of the things you can do. At the end of the day, Alex, I think what we're talking about is, we're living in times of such uncertainty, inflation, the job market, whatever it may be, that at this time, better to be safe than sorry. Kind of tighten your belts. Don't spend money that you don't have to, and just kind of, just prepare for the worst, hope for the best sort of situation. What do you think?
I am on the same side like you. Shrink and be very careful with your expenditures, and be focused to be able to be in the good books in the bank.
Yes. The banks are obviously going to try to work with you the best that they can. And, nothing's for free. Anytime they make some sort of adjustment for you, they're going to throw it into your they're going to throw in their charges and payments into your monthly payments, and you're going to end up paying more bottom line. But they too have limits. At some point, it's going to turn ugly if you don't kind of do this. I guess what I'm trying to say is act on this preemptively. Don't wait to the point where the bank picks up the phone and calls you. You call them, find out what's going on, be very, very proactive, and like Alex said, get yourself a cushion and make sure you don't end up in a bad situation.
Absolutely, I agree with you.
All right, let's, Alex, move to the market, the real estate market update. The numbers came out recently, and I'll be honest with you, I wasn't surprised to see that they were very similar to what October and September were doing in terms of average prices and number of sales. So we are consistently seeing that the sales for this November were down about 50% compared to November of last year. No surprise there. Compared to the month before to October, sales were down about 2.4%. So the total number of homes sold was down about 2.4%. Compared to last year, November 2021, our average price is down to by 7.2%. So we're actually sitting at $1,079,000. Keep in mind, this is an average for all of the Greater Toronto area. Yes. And compared to the previous month, compared to October, we're actually up 0.3%.
Yes.
Right?
Yes.
So our average price is up a little bit. But I mean, I guess it's still the same. Not much has changed in terms of what the market's been doing for the last 3 months, I would say. So it's fair to say that we've kind of we're grinding sideways in terms of price point. Not much is changing. In terms of locally in Mississauga, I took a look, and we are, believe it or not, in terms of average price, we are right now at $1,022,000, and last year we were at $1,039,000. So there wasn't a big difference in average price. Our average price in Mississauga, actually, we're down like 2% compared to the year before, as opposed to the 7%, which is the average for all of Toronto. So in that sense, Mississauga is doing pretty good.
Better than Toronto.
Better than the average, I guess I would say.
Yeah.
Our inventory, months of inventory was 0.8 last year. 0.8, right? That's insane. Like, that was a very hot market. Right now we're at 1.7 for Mississauga, and I believe the average for Toronto is like 2.5. So it's not a hot seller's market, but I mean, I would still say that this would qualify as a seller's market. 1.7 months of inventory.
Yes, and but from other hand, you see, we have reduction of total number of listings for 11% November to November.
Right.
And it's also, but the days on the market, in spite of the fact that we have only 11% drop of total new listings on the market, days on the market significantly increased for 18 days in November 21 to 33 days in November 2022. So
33 days, okay. So was that for Mississauga or all of Toronto?
All of Toronto.
All over Toronto, okay. So again, once again, Mississauga's numbers are actually better. So you're saying all over it was 33 days for Mississauga. It was 24 days on market. So, better numbers, I guess.
Absolutely. I agree with you. So, and leasing activity is also reduced. In second quarter was less for 12% comparing second quarter of last year. And overall sales activity is reduced for 42% year over the year. So condominium sales, if it go in different niches, total condo apartment sales is reduced for 46% comparing last year, third quarter, right?
Okay.
So we can go in so many details and numbers, but really, if somebody is looking for more details, we can definitely give more details about that. What really took my attention, it's average one-bedroom apartment rent.
Yes.
In the third quarter of 21, average rent for one-bedroom apartment was $2,061. In third quarter of 2022, so it means after 1 year. Believe it or not, average one-bedroom apartment rent is $2,481. or average increase for 20.4%. One bedroom condo apartment rent.
Yeah. I am hearing, though, through the Vine that the rental market is softening. I don't have any hard numbers right now. Some of the people I'm talking to, the rental market is softening. Let's see. Let's watch out for that next month and see what happens with that. So you're saying the average one bedroom is 2,400 and change right now? Let's
change is almost 25, 2481. So almost 2,500.
Yeah. So let's check into the next month, see if that's softened a little bit or not. At some point, because these markets are very fluid, at some point things have to adjust. And when we have a lot of inventory on the market, then the rents may come down. But let's check it out.
Absolutely.
So I guess overall, it's safe to say that, whether in Mississauga or all over Toronto or different suburbs of Toronto, what we're seeing is sales are down half of what they were last year this time. And prices are anywhere from 5 to 7% are down compared to last year. We're basically sitting at last year's prices at this point right now. What impact is the latest rate increase going to have on the market remains to be seen. I think anytime there's an interest rate hike, I think we should give the market maybe a few months to adjust to that rate hike. So, we're in for a couple of months of observation to see what is the true impact of what's happening.
I agree.
One thing that hasn't changed yet is, we've touched upon this before, is that new home sales. So, these are resale home sales that are down 50%. New home sales are down like 90% compared to last year. And, that's a red flag, right? Because we can expect a shortage of inventory in a year or 2 years when, when the rates are hopefully lower at the time and people are back into the market. And that'll be interesting to see what happens when the interest rates start to go down, or when they are down to the point where people start buying. How is the rental market going to get affected at that point? So that'll be interesting to see.
I'm not sure that the rental markets will significantly drop because we have so many immigrants coming to country year over year.
I'll tell you what.
Huge force.
I'll tell you what. I had we just recently leased a condo for my client in Mississauga in the Meadowville area. It was a 2-bedroom and 1 washroom unit. $2,500 was listed for. I think we had maybe 8 or 10 offers on it, and we ended up with one. And I was surprised by the amount of people that were just voluntarily saying, "You know what? I'll pay the whole year's rent."
Oh, really?
Right? I'm tired of looking. Here's the whole year's rent, and I'll take care of the place, use my job letter and everything else. So the demand is still very high. 10 offers on an older condo building condo. Demand's still there. So let's see how that changes as time goes by. All right, I don't know, Alex. That's it for my end, my friend. Anything you need to add? Do you want to add?
No, absolutely. We covered all topics, and I'm looking forward to discuss about new topics next week.
Great. So, if you're listening to this, if you're watching this, if you have any questions, appreciate any feedback, please put it in the comment section. Reach out to us directly. Let us know. We're doing this for your benefit. So if we can improve upon it, we would definitely want to do it. And with that, I think we'll wrap it up. Alex, look, thanks so much for joining as always. And we'll see you next week.
Absolutely. Thank you very much for the invitation. And see you, of course. And let's see what's going on next 2 days about the weather. Take care.
We'll follow up. Okay. Bye now.
Of course. See you. Bye-bye.